The balance of payments. The balance of payments reflects the net flows of money between one country and others. It reflects the transactions of individuals and businesses as well as governments. Study of a country's balance of payments allows economists to identify where a nation's cash is going, in turn allowing the identification of unsustainable or undesirable practices that might benefit from government control or influence. While different organisations have slightly different definitions, in general the balance of payments is made up of two components, the current account and the capital account. The current account is usually defined the following way: exports minus imports, i.e. cash flows as payments for goods or services, plus income from abroad, perhaps dividend payments on investments, plus net current transfers, i.e. foreign aid. Think of the current account as being the country's income from production. The capital account is foreign direct investment, perhaps the purchase of income generating assets like machinery, plus portfolio investment, the purchase or sale of shares or bonds, plus reserve account, i.e. activity by a country's central bank. Think of the capital account as being the country's flows of investment. Overall, the current account and capital accounts must sum to zero, hence the presence of the word balance. Although in aggregate there must be balance, there can be imbalances between individual countries. Most developed world countries have floating exchange rate. It is the exchange rate that will ensure the balance of payments does in fact balance. Exchange rates. If a German woman buys a product from the US, she will have to sell some of her euros and buy dollars to pay for the item. In reality, there are millions of these small and millions of not so small currency transactions occurring every day. In aggregate, any meaningful increase in demand to buy dollars and sell euros will cause the US's currency to go up in value relative to the euro. This rise in the value of the dollar will make foreign goods and services cheaper and foreign investment more attractive for an American business, thus likely leading to a flow back to euros from US dollars in response. Study of a country's balance of payments allows economists to identify where a nation's cash is going, in turn allowing the identification of unsustainable or undesirable practices that might benefit from government control or influence. Some countries, like Hong Kong for example, don't allow their currency to float freely and seek to maintain a constant exchange rate with reference to another currency. This can make it easier for importing and exporting companies as they know what FX rate to expect when they buy or sell goods in the future. If the country seeks to push its exchange rate lower, the central bank will create more of the domestic currency and use it to buy foreign currency, thus increasing the supply of their own currency, which will push their exchange rate lower. If the country seeks to push its exchange rate lower, the central bank will create more of the domestic currency and use it to buy foreign currency, thus increasing the supply of their own currency, which will push their exchange rate lower. Alternatively, if their exchange rate is considered too low, the central bank will sell some of its foreign currency reserves to buy the domestic currency. The supply of domestic currency will then drop and the price of it, i.e. the exchange rate, will rise. Most developed world countries have floating exchange rate. It is the exchange rate that will ensure the balance of payments does in fact balance. The downside with a managed exchange rate is that a central bank may have to spend a lot of money to control the rate, and if this becomes unsustainable and the central bank is forced to change strategy, the adjustment to a floating rate can be sudden, extreme, and very disruptive to an economy, often ending in recession. In summary, the balance of payments is a reflection of a country's currency flows. It consists of two parts. The capital account shows the country's net investment flows, while the current account shows the country's net earnings. In aggregate, the two accounts must balance, and this balance is usually achieved automatically through a swing in exchange rates. If the country manages its exchange rate, the central bank will have to create flows to ensure the balance.